Imagine you walk up to your friend and say, "Hey, lend me $100 and I'll pay you back in 1 year with an extra $10 as a thank you." Your friend thinks, "Sounds good. You seem trustworthy," and hands you the money. Congratulations. You just issued a bond. And your friend just became an investor earning interest. That simple deal is the basic idea behind how bonds work. A bond is essentially a loan that investors give to companies or governments. In return, the borrower promises two things. First, they will pay you interest every so often. Second, they will give you your original money back when the bond matures. Think of it like a fancy IOU that pays you for being patient. Now, why do people buy bonds if stocks exist and stocks are often more exciting? Because bonds are generally safer and steadier. Imagine stocks as roller coasters with big ups and downs that can make you scream either from excitement or pure panic. Bonds are more like gentle train rides. Not as thrilling, but you usually get where you're going without wondering if you will survive the journey. Let's start by breaking bonds into their key parts. First is the principal. This is the amount you loan out, just like the $100 in our earlier example. Next is the interest rate, also called the coupon. This is the extra amount the borrower agrees to pay you every year. For example, if you buy a bond for $1,000 and it has a 5% coupon, you will receive $50 every year until the bond matures. Then there is the maturity date, which is the moment the borrower promises to pay back the entire principal. Bonds can mature in a few months or 30 years. Longer bonds usually pay higher interest because you are locking up your money for a long time. Now let's talk about who issues bonds and why. Governments issue bonds to fund projects like building roads, hospitals, and schools. Companies issue bonds when they want to expand, launch new products, or simply keep their operations running smoothly. Instead of going to a bank for a loan, they raise money from investors. And investors like bonds because the payments are predictable. You know how much interest you will get and when. There are no surprise plot twists like with stocks, where the price could jump or crash unexpectedly. But here is where things get interesting. Even though bonds are loans, they still have prices that go up and down, just like stocks. Imagine you bought a bond that pays 5% interest. Suddenly, new bonds are being issued that pay 7%. Investors would rather buy those new bonds because they pay more. So your 5% bond becomes less attractive and its price drops. On the flip side, if new bonds only pay 3%, your 5% bond suddenly looks like a superstar and its price rises. This dance between bond prices and interest rates is one of the most important things to understand. When interest rates go up, bond prices usually go down. And when interest rates fall, bond prices tend to rise. Here is a quick everyday example. Think of bonds like rental properties. If you own a house that brings in $1,000 of rent every month, its value depends on what other landlords are charging. If new houses suddenly rent for $1,500, your house is less appealing. But if new houses only rent for $700, your house is looking great. Bonds work similarly. The rent is the interest, and the house value is the bond price. Now let's compare bonds to stocks in a way that makes the difference easy to remember. Buying a stock is like becoming a part owner of a company. If the company does well, your stock might soar. If the company does poorly, your stock could collapse. With bonds, you are not an owner. You are the lender. Lenders get paid before owners during financial trouble. This is why bonds are usually safer. Even if a company is struggling, it still has to pay its bondholders before worrying about shareholders. And if the company fails completely, bondholders often get something back while stockholders might get nothing. Another factor that makes bonds safer is credit ratings. Every major bond issuer gets a score from agencies like Moody's or Standard & Poor's. It ranges from high-quality investment-grade bonds issued by very reliable borrowers all the way down to riskier high-yield bonds, often called junk bonds. Just like you might check a friend's reputation before lending them money, investors check these credit ratings to judge how safe a bond is. Higher-rated bonds pay less interest but are safer. Lower-rated bonds pay more interest but come with higher risk. It is basically the difference between lending to your super responsible friend and lending to that one cousin who always forgets to pay people back. Now, you might be wondering how people actually make money from bonds. There are two main ways. First, interest payments, which are steady and predictable. Second, selling the bond for a higher price than you paid. For example, if interest rates drop and your older higher interest bond becomes more valuable, you might sell it for a profit. Many people combine these two strategies to build slow but steady wealth. Bonds also play an important role in balancing an investment portfolio. Think of your portfolio as a meal. Stocks are the spicy part that adds excitement but can sometimes upset your stomach. Bonds are the calming part that keeps everything stable. When the market gets rocky, bonds often help reduce overall risk and keep your portfolio from swinging too wildly. Finally, let's look at one real-life example. During economic uncertainty, many investors rush into government bonds because they are considered some of the safest investments around. In 2020, when markets were crashing and everyone was panicking, government bond prices soared because people wanted safety. They were willing to accept even very low interest rates just to know their money was protected. That is the power of bonds. They provide stability when everything else feels chaotic. So when you hear people talk about diversifying your investments or reducing your risk, bonds are one of the key tools they are referring to. They may not be flashy, but they work quietly in the background, helping you grow your wealth without giving you emotional whiplash. Understanding bonds gives you one more tool in your financial toolkit and helps you make smarter, more balanced decisions. And while stocks may get all the headlines, bonds are the unsung heroes that keep your money steady and secure. If you enjoyed this breakdown and want more videos that help you understand the stock market, investing, and building wealth, make sure to hit that like button and subscribe to our channel. Join us on this journey to becoming financially savvy every single day. We've got plenty more content coming your way that can help you grow your money one step at a time. Thanks for watching, and I'll see you in the next video. Stay smart, stay rich.